Hey, good morning, everyone. Chris Johnson, finally Friday, April 24th. Got a lot of things to go through today, but most of it's going to come down to you. Looking at the chat right now. Good morning from Fort Worth. Good morning from Cincinnati. Tony's in Cincinnati. That's great. Who else do we have here? Long Island, New York. Hope everybody's doing well this morning. Hope you put some questions together. We're going to do a little free form Friday at the close of this. So the last 10 or 15 minutes of this morning's market open, we're going to dedicate just to questions about the market. I want to hear your questions about the market or ticker symbols that you want us to take a look at as a group here. I think it'll be good fun. Nice way to wind down the weekend. Nice way to get ready. So California, oh my gosh. I think we're in the 50s here this morning. It's rainy and it's Cincinnati doesn't look as nice as California, I'm sure, although we have our days. So anyhow, let's jump right into the charts. We've got a couple things here that I want to share with you before we get to our free flow Friday. The market's technical test revisited. Remember yesterday, Cheyenne, Wyoming. Wow. You remember yesterday's talk that we had about the S&P 500, its 50-day moving average in the 2,800 level. Well, that actually came out to play. And if you guys were watching the market throughout the day, you know that especially when we came into the close, we ran into those technicals that came down. We're going to look at that real quickly. Two earnings results we're going to watch. Actually, there are two that I think we should be trading. These are two stocks that you'll look at, and these are part of the longer term outlook. One, a longer term buy we talked about earlier this week as the number one dividend yielding stock on my list. There's a hint for you. And the second one is a well-known semiconductor company, kind of usually is one of the canaries in the coal mine for the industry or for the sector. And they did well on earnings, but the outlook wasn't so well. And what does that say for the earnings or for the group here? Semiconductors have been slowing down of late and consolidating. Next, we're going to hit the ongoing retail story and what it means for you. The reason I'm doing this is because of the reading I was hitting last night, late into the morning. This is a situation, and I've used that term ripple effect, but last night I saw the word tsunami when it was describing what's happening in the retail world. I want to talk a little bit about that. We've talked about a couple of stocks that look good, Ollie's, for example. And then we've talked about the stocks that you want to avoid, Macy's being one of those. I've got a couple of the REITs that I want you to take a look at avoiding. Obviously, we talked about Digital Realty Trust yesterday as one of the REITs that I think is great in terms of a nice dividend yield and growth. But there's some out there that really have some problems coming down the road simply because they're got exposure to the retail world. We'll hit them in a second, though. And then it's going to be all about your questions. So give me about 10 minutes to get through these, maybe 15. And we're going to have about 15 minutes on the other side for everything that you want to talk about. So the market's technical test part 2. Resistance held true on the S&P 500 yesterday during the trading session. Stocks floated well above it. And we saw a nice rally right out of the morning, got stronger into late morning, and then backed off. Call it whatever you like. There were obviously, you had studies on remdesivir. I still can't. That's a mouth load for me, though. There was a study in China, and the WHO released it saying that the drug wasn't effective as that leaked story that we saw last week from Stat Magazine. So there's a lot of questions around Gilead and what's going to happen here. If you followed what we talked about last week on Gilead, you actually probably made some money. We talked about when Gilead spiked after the news of that drug hitting the street. We didn't think it was going to go over that 85 level or so and be able to maintain it. I told you this was clearly a sell the news situation for the stock. Talked about doing maybe a credit spread on the stock at that point, and it would have been a fantastic move. Premiums were high on it. You could have collected some nice premium against margin, and the stock just fell right off the table. Or we did mention a couple instances about maybe going out and buying the puts, the 85 puts or the 80 puts on it. And obviously that would have worked out well for you. So just try to, when we talk these little trading sessions in the morning, I hope that you're taking a little bit of these notes for you. Go off and use the trade ideas if you see fit to use them. There's money to be made in these morning conversations. And that's part of the reason why I think I enjoy them so much. So let's get back to the slide. The VIX VIX was also, I've got a slide of the VIX here in just a second that you're going to see. Let's go back to talking about that market and hanging up. Stocks retreated late afternoon after a 2% rally during the day. Volume remains light. This is a message I got tired of saying it last week because it felt like that broken record, Groundhog Day for me. Volume has been lightening up as we've been heading into this consolidation and that resistance coming down on the S&P 500. That lightning volume tells you that traders, the people who are out there that are moving much more than you and I are on a daily basis, are losing confidence in the rally. Losing some confidence on the rally means that they're going to start turning around and selling the positions that they've got that were up 20% from the March 23rd lows. So that's why I watch that volume so closely. Small cap sector, they had a reversal yesterday. It was up almost 2.5%, closed up 30 basis points for the day. There is my, by the way, if you're keeping track at home, there is my typo of the day, indicating the risk on trade remains off. So the risk on trade remains off. Let's look at these charts right now real quickly so we can see what I'm looking at. There's your S&P 500, 2,800, holding the index down. Futures are up right now, and they were up just slightly this morning, going into the trading, just as they were yesterday. And we slipped right back below that the 50-day moving average. This is nothing to be fooling around with in terms of throwing or casting a doubtful eye on it. The technicals are going to speak loudly right now. This is a technically driven market. So the traders are going to take their cue from this failure. And you're going to see what should be, especially as we get into a heavy week of reporting next week. This was just a warm-up week. Next week is where earnings really come into play here. So if we look at this, that 2,800 is going to be resistance. We don't want to cast a kind of lazy eye on that and say, it's going to pass here, especially as we go into earnings right now. So let's keep going on to the VIX. There's your chart of the VIX. We stayed above 40 yesterday, talked about 40, not only with you guys, but 11 o'clock on my Night Trader live stream as well. We're long the VIX right now in terms of a call on the VIX, long that volatility because the VIX I mentioned the VIX breaking above 40 again, as it did last week. And then we saw it move above the 50-day moving average, got a signal from the Night Trader system that volatility was now bullish again. So time to go long volatility with a target of 60 on the VIX. Probably going to go a little bit higher. The VIX always knocks twice, just like the postman knocks twice. So we're likely to see that 80-85 scenario play out here before all is said and done. So there's your chart on the VIX, and then the IWM, the risk on trade indicator. We'll look at Micron here in a couple minutes, Charles. Actually, you know what? Make sure that anything you're asking for me to look at, make sure you repeat it when I talk about the Free Flow Friday here in a moment, because hard for me to scroll up and look at all the chats here. But anyhow, the IWM doing the same thing, consolidation, but you're seeing lower highs here and a little bit of a pennant. That 20-day just starting to creep up a little bit here right now. And if we break that 20-day, it's going to be off to the races to the downside for small caps. Keep in mind, a lot of this rally has been driven by fiscal activity. We saw, obviously, the House approve that bill yesterday that's going to put more money into the PPP, also going to put money into the hospitals and some testing. The testing is woefully lacking right now, and that's what everybody's complaining about. I saw somebody from Georgia saying that they're going to be the first one. Georgia is going to be the first state to open. There's actually a mall in Nebraska that is opening today, a mall that's opening. And I've got that in my notes here in a few seconds because it's going to be the canary in the coal mine for the retail area. But IWM breaking down, S&P 500 below that 50-day moving average and the 2,800, and the VIX moving higher. That is an equation for some weakness in the market. I feel like a skipping record when I say it, but time will tell, and I'm fairly sure we're on the right side of the trade right now in terms of where this market's going to go. So 2 earnings results to watch, and these came out last night and then this morning. Intel was last night, Verizon this morning. This morning they beat by 4 cents, missed on their revenue, guided their fiscal year 20 earnings per share in line. The revenue guidance also as well. So I'm sorry, they withdrew their revenue guidance. So they're saying we're not going to guide on where the revenue is going to go, but we think that we can manage the bottom line, the earnings per share, through cost cutting efforts. Right? That's exactly what Verizon's telling you at this point. The company sees strong enough activity to guide that next quarter in line. But again, they're dropping the fiscal year, and that's what most of the companies are doing right now. It's going to be almost a boilerplate portion of the earnings reports or the conference calls as we move through earnings season. So expect to see it a lot next week, dropping of the fiscal year 2020 guidance. You'll still see some earnings guidance or revenue guidance along the way. Revenue is going to be the big one because nobody really knows where that revenue is going to come from. The shares have been consolidating for a couple of weeks here. The stock's gone quiet. It's what I like to call gone quiet. When you look at the volatility of the stock, and I don't mean implied volatility like the VIX, but the actual movement of the stock over the last couple of weeks, it's been trading in this tighter range, which tells you that people have been sitting on the sidelines and waiting for something to happen. That consolidation is good because it's happened in a bullish trend here. So the stock has maintained its bullish posture. Now you've got some good news from Verizon. And as I mentioned, this was number one on the list that we went over Monday in terms of dividend yielding stocks that are going to give you growth potential for the rest of 2020 and into 2021. So it's a good dividend yield as well as providing you some solid growth here. Verizon, as I mentioned, I mean, this is one of those stocks. If you're a dividend yielder that you're looking for that yield for your portfolio right now, forget about looking at the 10-year and looking at bonds right now because the yields are getting crushed as we see bonds go higher. So what does that mean? How does the chart for Verizon look? There you go. Here's the consolidation I was just talking about the last couple of weeks between 58.5 and 57. We're going to see a breakup. It's up about 1% this morning in pre-market trading. I think we take out that 60 level, which was a lot of resistance when we saw it back here in January and December, right here before everything kind of fell out. The stock, as I mentioned, has been climbing higher, the 50-day turning back up again. It's not a full-on bullish signal because of this consolidation, but look at that 20-day crossing above the 50. It tells you from a trader's perspective that this stock is going to be something that's going to continue moving. I've got a target of about $61 over the next 3 months on Verizon. So you get a good dividend, you're going to get some growth out of the stock, maybe 6-7% out of the stock over the next couple of months while the rest of the market is kind of writhing around on the floor. I think that this is a good hold, and I call it a hold. It's not a trade. It's a stock that you should have as a foundation of the portfolio. So let's move on to the other announcement. Intel beat by 18 cents. They beat on their revenues as well. They guided their earnings per share below consensus and their revenues above consensus. That's a weird mix to be seeing in this market right now. They didn't give any guidance for 2020, their fiscal year. Look at the second line here. Data center business was strong again, up 34% in the quarter. And I've got in parenthesis there, remember our bullish call on DLR. The reason I put that out there is I believe that if you look at what's going on right now out there, the companies, and this is a good dividend yielder as well, DLR is one of the real estate investment trusts that's got a good foundation right now. It's bullish. It's actually above the 50-day, which is trending higher. Two categories as part of my system that are very important. At the same time, it's got a short interest telling us that the people are, let's call it, ignoring the stock. I'm starting to refer to this as price elasticity. There's elasticity to move higher in the stock right now. It's not overbought. Another item that kind of checks off a bullish mark here. DLR, by what we're seeing from Intel, the data centers are busy. That is one of the areas that they actually specialize in. A lot of people bring up Iron Mountain, but they're more of a document storage, and they do storage of technology. But the data storage facilities are going to become larger and larger in that real estate investment trust area. That's where you need to be instead of the real estate investment trusts that look at the malls or the retail sector. So let's go back to that chart of Intel. Right now, Intel is, and the part in red, this is one thing that has really struck me. I shared with you last week about the breakfast I was at with Steve Forbes, where he said, hey, trouble starts to hit the market when the CFOs take over and the CEOs kind of step back. Well, last night I saw the CFO for Tyson Foods on CNBC talking about the situation where they're closing down plants. Now we're hearing from Intel's CFO that they're going to focus on cash flow management without constraining growth and technical development. That is a long way of saying they are watching their cash burn rate, which is a term we haven't heard in a while, cash burn. You're going to see more of that over the next couple of weeks with the earnings season progressing, but it is a warning sign that these companies are kind of putting down the hurricane shutters and waiting for this storm to come in, because there's a storm coming in from that economic ripple effect, which some people are calling a tsunami. And now they're trying to make sure that they've got the cash to make it through the next couple of months, maybe even the next couple of quarters. Intel's chart, not as great right now. Today it's down 5%. It's going to be opening around $55 or so, below the 50-day and the 20-day moving average, and below the bottom of that range. You can see this is going to be kind of a straw that breaks a camel's back, I believe. You'll see Intel start to trend down towards that 52 level. The reason is because part of their announcement was that everything from automobile manufacturers to phones to refrigerators, all of these things that they create semiconductors for, they're going to see reduced demand as you look over the next couple of quarters. So kind of an indication of what we got coming from not only auto sales, but also from looking at things that, consumer products that we purchase. The ongoing retail story, I just want to hit on this for a few minutes, and then we're going to have about 10 minutes to start going through your questions and answers. Just put this together this morning because it was some notes I wrote down last night, and it is just getting started. We've talked about retail in terms of Macy's yesterday, and Macy's is out there trying to get some backing through the debt market. They're also, we're talking about, and I think it was an interesting discussion we had yesterday about how Amazon may take this opportunity to get a physical footprint in some of the areas that are a little more intimate, that it's hard to buy over Amazon, such as apparel, shoes, things like that, electronics and all that. That's fine. I can go to the Best Buy and look at it and figure out which one I like and buy it off Amazon or get them to match the price. But clothes are a tough one for Amazon, unless it's socks. So if we look at this, we're seeing the first soft opening of a mall in Nebraska today. I think it's called the Nebraska Crossings Mall, and it's going to start to serve as a canary in the coal mine for the rest of the sectors. Many retailers are already saying that they don't want to open yet, as a lot of the states are not in compliance with what the measures that are announced by the president's administration. Another interesting thing I saw in the news feeds this morning is that the administration is actually talking about lengthening the social distancing that they have in effect at the federal level, not even at the state level, but at the federal level. And it's at the same time that you have states that are trying to figure out how they're going to reopen. So I think a little bit of confusion and cluster over what's going to go happen with these openings. But what we do know is that the retailers are going to suffer, and they're going to suffer big. At the mall level, anything you own at the mall level right now, I think needs to be that we cannot be owning individual companies that have doors that are closed right now and are going to remain closed for some time. Retailers at the mall level need to be jettisoned from your portfolios. I've already gotten rid of them from mine. Portfolios shouldn't be holding those. Closing and bankruptcies are going to be hitting historic levels. One gentleman was on CNBC this morning talking about how the bankruptcies that they saw last year, and it's somewhere in the order of 100 large companies that went bankrupt last year in the retail sector. And now he's talking somewhere between 500 and 1,000 going bankrupt this year. That's a huge number that's going to have to be digested through the markets. REITs that operate malls should be avoided. Put those in isolation right now, along with the leisure companies, Royal Caribbean, Carnival Cruise Line, the airliners, Delta Airlines, et cetera, all of those in isolation. And here are 3 examples of the companies I'm talking about. Simon Property Group, SPG, this REIT actually trading down at $50. Poor technical picture right now. And as we see these malls start to wonder whether or not they're going to open up or not, I think we're going to have another wave of selling on SPG. Another one is the Tanger Factory Outlets. These are those premier outlet malls that you see in the middle of nowhere, sometimes on the side of the highway, made up of stores, everything from Brooks Brothers to Nike to Adidas and some of the nicer cookware stores and such. Again, this is going to be a lingering problem with them not being able to open up doors. And when they do open doors, what kind of traffic is going to come in? But more importantly, what kind of storefronts are going to be closing from these. So SKT's also in that isolation booth right now. And then Maceric, it's MAC is the ticker symbol on this. Similar picture. That chart looks exactly the same as the other two. This is going to be a situation where you want to keep that in isolation. And I've got Gus asking what I recommend puts on SPG. I'm recommending right now that all of these to everybody, this is a situation where you can get defensive in the REITs just like you can in the financials. The financials are starting to show this. The financials are starting to show some cracks in the foundation. So these are certainly candidates for puts. If you trade them, I'm not putting out specific recommendations on them right now. I'm tracking them with the night trader system for movement below these support levels, because that's going to indicate that there is another round of that selling that's actually going to take them lower, and we'll put them into put categories. So that's going to actually wrap it up for the slides, believe it or not. Now we've got a little free flow Friday. We got about 8-9 minutes or so that we can have some fun with, look at some charts. I can answer some questions, put some questions together about the market. What do I think about I don't know. What do I think about I've already told you what I think about the retail. What do I think about large cap tech? What do I think about small caps? And put in some ticker symbols here. Take it from me. You take the wheel, and let's see where we go here. And you should put anything that you put in earlier, go ahead and put in again. And let me pull up a chart while I do this so that we can start to look at the charts as well. Walmart, Amazon, trend. Winners in the retail sector right now. This is a great one. I'm just going to jump on Walmart and Amazon simply because I'm coming off the retailers. These are the survivors. Darwinism is going to be the name of the game in the retail sector right now. These are going to be the companies that continue to lead. I don't like, and I had a discussion with somebody from my office last night, late at night, and we both agreed we don't like Walmart. We don't like shopping at Walmart. There's something about it that just doesn't, it's not fun. It's very utilitarian, but at the same time, you can get everything we can for my house at the Walmart. Same thing with Amazon. Yes, these are companies that right now I look at and say Walmart is something that you own in the retail space. Amazon is something that you own in the retail space. Amazon is going to take advantage of this, and Amazon is going to be more strategic about this than Walmart, and that they're going to take advantage of this and expand their footprint. I believe they spent years putting together a logistics network that gets stuff to our doorstep. I think they're going to want us to come a little bit around the corner now to go and see them and buy stuff from them. And you've got already your pickups, your Amazon pickup spots where you can go at. I think they'll go one step further, and you're going to be able to start buying stuff, kind of like Panera did with groceries. They're starting to sell groceries here, getting them in the door. Target, I saw. I'm just going to keep scanning up. Target, yep, I like shopping at the Target. It's a nicer experience for me, but part of it is that they haven't been doing well on the margins right now. And we saw actually with the news that they dropped on us yesterday that's affecting the stock price. I take Walmart and Amazon over Target right now in this market. When people start thinking about consumer spending again or discretionary spending, that's when you start looking at Target again. I saw Shopify pop up on the list. So yes, I'm bullish on Shopify. I think it's overbought, and that's why we're seeing it pull back at 660, 650. It's going to pull back to the 560 or 540 region, I think, on this next market-induced sell-off. I think you could see it get down to that 560, definitely below 600. Boy, I sounded like the Rain Man there for a second. Definitely below 600. Anyhow, I think you go down to the 560 and a limit order there is probably a good place to start buying it. Netflix going down to 400. If those of you that obviously somebody's been following what I've been saying, 426 right now. I said it was going back to 400 when we were trading up about 450. My answer to that is yes. The number that they threw out there in terms of the subscription numbers is through the roof. That is not going to be replicated in quarters to come because everybody signed up because they were indoors. And again, Netflix is going to have to worry about two things: keeping those people in those subscription services. And the second thing is, how do they get their production up online again so that they're not showing, the Tiger Kings with people just doing these weird interviews. They have to get back to a full-fledged production schedule because that's what keeps people on Netflix when we're able to go outside. What is my favorite cloud computing company? You know what? I'd have to, this is going to sound terrible, but I'd have to go with, believe it or not, Amazon there. Amazon with their cloud, they've done just a fantastic job. Microsoft also has made a lot of ways or a lot of headways with their Azure product. But man, Amazon has been kind of the standard or the gold best in class right now. And of course, it's part of Amazon. I think that they've really done a good job of pulling up their cloud computing. 2 years ago, it was making up somewhere in the neighborhood of 50 to 60% of their revenue because, as you know, it's one of those situations where they don't make a huge amount on the actual sale of those products. So Zoom went up yesterday. Do I think it's going to go down? I do think Zoom is going to go down. 4 weeks ago, I recommended that you put a limit order in at 120. We got filled at 120 when it pulls up down here. Now we're sitting at 170. Zoom came out and announced that they had, I think it was 30 million users using it in the last month or so, and that blew the doors off the 2 million user. This is a situation kind of like what we see with Gilead. When it shoots higher like this, and Netflix, when it shoots higher like this, don't buy this gap higher. Look at a 150 or a 140 price for Zoom right now, and I think you'll be happy that you're going to get filled at those prices instead of paying 170 right now. To give you an example, if you had got in at that 120 on Zoom instead of the 145, you'd be up 38% today from this point where we bought it at with that limit order. If you'd bought it here, which is the day that I issued that recommendation to buy it at 120, you'd be up 18%. So you have to look at this from the perspective of getting into these with just a little bit of a discount. You don't have to go out there and say it's got to go down 50%, but it has to come down 10 or 20%. That's how you beat the mean markets, and that's how you bolster up your portfolio returns. Francis, you're right. Netflix is saving money on their production, but their people are ripping through everything that's online. They're going to have new content up there, and it's not going to be as easy as going out and getting a new show like Seinfeld or something like that on it. They just lost Friends because you've got Hulu and the Peacock now that's coming online that are all these other streams, and they're licensed to other streaming services right now. So they'll continue to have some movies coming in, but Netflix movies are actually kind of light right now anymore. I was just looking for movies to watch the other day. Amazon's got a much better movie selection online than Netflix does right now through their product. So that's, exactly where I sit on I'm starting to have to scroll up here. Sorry. On Netflix. Banks, call or put. Right now, it's short the banks. XLF has been rolling over, showing a lot of weakness. When you look at the large centers in the XLF, the large banking sectors, look at this. XLF is challenging that 20-day moving average, and it's breaking below it right now. You're not going to have much of an opportunity, I think, for the financials to start taking any leadership here. I'm looking for the financials to continue lower. Look at Citigroup, which would be another one of the stocks that give you that canary in the coal mine for the financials, trading below the 20-day. Bank of America, BAC, trading below the 20-day. Goldman Sachs, it's going to be a little bit different picture. It's trading above the 20-day, but the same pattern. You put the three of those together, and that is your view on the financials, the XLF right now. Technical trouble and not leading, which is an implication for the market as well. I saw somebody ask about Fifth Third Bank. We have puts on it. The stock has been holding on to that 20-day and trying to bounce higher. We'll see where it leads today. Again, a similar picture to those financials. We just got done with a heavy week of reporting for the regional banks. So that's one of the reasons why you've got Bank of the Ozarks, Key Bank, and Huntington Bank, and a couple of others coming out and giving some support for the sector. But again, this is going the same route as the rest of the financials. And if you want to watch something with the banks, watch that 10-year. And we've got a lot of people aren't talking about look at the 10-year continuing to slide, which pressures. A little bit of a sidetrack from the questions, and I'll take 3 or 4, maybe 5 more real quickly if you'll stick around. But keep in mind, Fed announcement or a Fed meeting coming up right now. I just heard last night the first kind of bumblings or hums or buzzes or whatever you want to call it about negative interest rates. Negative interest rates are officially a discussion topic right now as we head towards the next Fed meeting. Negative interest rates are going to be something that I think a lot of people will say, no big whoop. But at the same time, when we're putting out this much, it's going to be a gateway to putting out more debt at the government's level, at the national level right now, federal level, which is starting to affect everything, including the gold trade, helping out gold. So make sure you keep a bullish eye on gold, especially if we see those negative interest rates. I think that's going to affect the trade quite a bit. But let's go back to a couple more questions here before we shut things down. Gold every other day. And look, I just look up in KK saying gold every other day making money. What's your 6-month trend outlook? My 6-month outlook for gold right now is that we continue to see a bullish trend. We're seeing a breakout. Let's pull up that GLD share, stock chart right now and look at the breakout that you're seeing at 160 on GLD. I like the breakout here. The trend is strong with the 50-day moving higher above the 200-day, the 20 days tracking along, telling you that the traders are continuing to get into this. Gold is looking at a breakout. Barrick Gold, GOLD, sorry. Barrick Gold is one of the beneficiaries of that. You know, there are they're reaping the whirlwind, or they're getting the tailwind strength right now. It moved from 26 to 29 almost yesterday, 28.50, and then came back by the end of the day as the market kind of retraced. Individual gold companies are now breaking out, which tells you that the streak in gold is alive. The 6-month trend outlook, I think, is going to be positive, bullish, and I think you'll see gold probably appreciate somewhere in the neighborhood of 20 to 30% over that period. Buy Gilead, G-I-L-D, on this pullback, I'm sure is what you're saying right now. Gilead moving back down to that 74 level yesterday. You can see nice big drop in it. We'll see where Gilead takes us. Watch the 200-day moving average on this and the 50-day moving average, folks. The 50-day is sitting right below at 74 bucks, let's call it. Watch that 50-day because Gilead has not really closed below that 50-day since the end of January when we started talking about COVID-19 or just coronavirus. A lot of biotechs, and you can look at the IBB, a lot of the biotechs have been in that same pattern. The IBB has been very strong. It did see a pullback, but leading the market now. I'm not sure if I'm stepping into Gilead until I see if this technical test is going to be a winner or a loser for Gilead. Watch the 50-day. If it breaks below 50-day and makes a couple days below it, it's going to look like it's a good short candidate because it has been high with premium. MasterCard, I saw flash up on that. Bearish right now. Visa's giving you the same sign. Consumer activity obviously slowing. MasterCard and Visa have both been suffering, and you have to think about the retail. What we just said with the retail stocks is going to continue to affect. And sure, we're going to continue to buy groceries and things like that. But one of the messages we need to take from this last 2 months and then the next 6 months is that our spending habits have been changed. People have been staying inside, doing things that are simpler, not going out and spending lots of money. And I think you're going to see that continue. We're not all of a sudden going to be going out to concerts and doing things that we spend money on and use those Visa cards for. Instead, we're going to be a little more conservative. People are kind of pulling back the reins right now on their budgets. And of course, Visa and MasterCard are going to be affected by that consumer discretionary spending. Keep an eye on it. I think it was a great narrative, the Coca-Cola story I told you earlier this week, where we said, hey, Coke is not about just Coke being on the shelves in your house or the pantry like my father had it when I was growing up. Coke is an experience. It's buying a Coke at the ball game. We can't do it. It's buying a Coke at a concert. We can't do it. It's buying a Coke when you're driving cross country on a trip. We can't do it. It's a point of purchase experience, Coca-Cola is. And it's the same thing with Visa and MasterCard. That point of purchase experience is going to be lacking for some time. I hope that little narrative or that description helps you understand why I look at those two. So let me look at two more, and I'm just going to randomly pick them, folks. I'll give you some time to look at them tomorrow. You know, Charles is always an active participant, so we're going to go with Goodyear Tire for Charles. Obviously, the thing you have to look at here is twofold or threefold. You have to look at what's going on with the automotive industry with Goodyear Tire. And then the fact, I think it's kind of a short-term story, the fact that we're just not driving our cars around. Goodyear right now sitting at $6.64. I think you probably see a test back to that $5, maybe not the $4 levelers as much, because those companies like Ford are also in the same situation. And the selling has been done for the most part even though I think you can see a little bit more, you've got a nice technical base that's starting to build around that $4 level on Ford. Goodyear Tire, I'm not one to rush in and buy this. Wait until you have a break above that 50-day and we start to see the trend moving in a friendly direction instead of a mean to market direction. And that's the time to buy Goodyear. A rule in this type of market, folks, is to give up. Don't try to catch the exact bottom on a stock like Goodyear. When I say it's going to go down to $4, don't try to buy it right at $4. Buy it at $4.50 or something like that. Give up the first 5 or 10% of a rally so that you can make sure that you're buying it as it's going in the right direction. It's a process that I followed when I managed money, and the same thing can be said for tops. Go ahead and give up the last 5 or 10% of the rally. If you have to get out when it's starting to get sketchy, so what? You made your money. As they say, the hogs get slaughtered. Don't be so greedy. In the same sense, don't try to catch the exact bottom here. You just lose a lot of your senses, and you lose fingers as well from that falling knife. So Goodyear Tire, give a little bit of time to kind of evolve into a more bullish trend. At least get that 20-day moving above the 50-day, and that's the time that I'd get in there. Finally, going to go for one more. Gosh, now I've got to go with two more. TVIX. Oh, I put in a Y. I'm sorry. TVIX. So we've got this is actually going along with the volatility play here. Yes, you know what? This strong. My goodness. You know what? I'm gonna have to do the thing that I don't do that often, Guy or Guy. Maybe you're from Canada and it's Guy, but this is one that I'd have to look a little closer at, because whenever I see a chart that's spiked up to 1,000 like this, obviously a very good correlation with the volatility in the market. I got to look a little bit closer at this. This one's going to be a little interesting to me. I did that once on CNBC when somebody asked me about a ticker that I didn't have enough knowledge to say something. I said, hey, I don't have enough knowledge to say something. They went, wow, that's a great answer. I'm going to do the same for you, but I'm going to write it down and we're going to talk about it on Monday for sure. Give me a second as I write it down. And the airlines, Elsa, steer clear of the airlines. Delta gave us a bad outlook for the airlines, obviously, with their earnings. You're going to see more from the other airlines. United is sounding the alarm right now. They're looking for that money from the government right now to help them get through this rough spot. But when they come out on the other side, and Delta is a very large operation in Cincinnati, when they come through on the other side, they're going to be operating at somewhere between 20 to 30% of the capacity that they were operating at in January. So this is going to be a long rebuild for the airlines. Royal Caribbean, I saw up on the ticker list there earlier. Same here. We're looking for the next step down here. The 20-day is starting to try to give way for the stock. You're seeing it get closer. A lot of these companies are just kind of in this rest period where they've been tired, they've been exhausted from going down. A vacuum of selling is normally what I refer to it at. And in this case, the airlines are no different. But once the reality starts to set in, we'll actually start to move a little bit lower. The last one, Alcoa, I'm going to hit. And Ken, while this is coming up, May through September, usually August, pattern trading downturn, how to protect yourself. I like this question because it has to do with the sell and may go away. People aren't done selling right now. This year is not going to be a traditional seasonality move between May and September, in that you're going to have so many things coming up and down the pike, everything from more fiscal stimulation from the government to more news coming out on how much we're not spending. I think the downturn is going to be very real. I outlined, and you can see it online at Money Morning and a few other places. I outlined some puts that you can purchase that are protective puts that go out till October on the S&P 500. I think that's the best way to hedge a portfolio right now and to protect yourself in this market. You can also use the SDS shares or any of the other inverse ETFs to help offset some of the volatility to the downside here. So Alcoa, the last one I was going to pick, another one that I'd say is going to be going through the same situation as the airliners. We've had a rest in the selling here. You've got a vacuum of selling pressure, but the volume picked up yesterday. We're obviously earnings season here. I think the 20-day is going to give way on Alcoa, and you've got probably a $5 to $4.50 target on the downside here. On the downside, and that's before it starts to base out. Watch for the materials companies to continue a little bit of more suffering, kind of like oil, that crazy trade in oil. The materials are going to see the same type of trading here because demand is going down. Except we looked at those rail car numbers yesterday, or we looked at the rail car results from CSX, and we know now that companies like Trinity and some maybe Vulcan Materials, those companies that do work on roads, industrial work, asphalt, etc., are maybe doing a little more activity than we thought. So basic material wise, you could look at those companies, but I think Alcoa is going to be one to slow down. All right, guys, I hope that this was fun for you. I love sitting here. I feel like an auctioneer going through the stocks, calling them out and giving you prices, et cetera, et cetera. We're going to do this every Friday because it's just that much fun. I also have some great questions here that I might try to use for some commentary. I save your chat every day so I can kind of look at it and look at feel the pulse of it. Next week, we're going to start off the week looking at earnings on Monday, as well as some volatility stocks. And then I've got a couple of other surprises up my sleeve. So I look forward to seeing everybody early on Monday morning. Hope you're going to be here with me. Enjoy your weekend. As always, I wish you the best trading success, and I look forward to seeing you on Monday morning. Have a great weekend.